Yeah, okay, so as I said, I'm Dan Runde. I hold the Schreyer chair here. And thank you all for staying. I think we've got a lot of takers to actually come for the second panel, and I really appreciate everyone being here. I think it's we have over 450 RSVPs, which I think is speaks to the topic. What I wanted to do was to bring together some thoughtful folks who I think can help us talk about the future directions of impact investing, but also the role of donors, development finance institutions, philanthropy. They've all had roles to play in the development of the impact investing space. We've got four very thoughtful, experienced panelists for the second panel to look at some of these larger issues that I think are related to, and it's related to this first panel. We had a lot of discussion about the current marketplace and what it is. And so I really, let me just go, I'll just quickly introduce each of them. I want to first introduce my friend Elizabeth Littlefield, who is one of the most respected people in the Obama administration and a very effective leader of OPIC. She's the CEO of OPIC. And then Saadia Madsbjerg, who is a managing director at the Rockefeller Foundation. Rockefeller has had an important role to play in, let's call it, standing up the field of impact investing among many other players, but has had a contribution to play. We also have Julie Katzman, who's the executive vice president and the COO, chief operating officer of the Inter-American Development Bank. She's had several very interesting past lives, including running at the Inter-American Development Bank something called the Multilateral Investment Fund, which I think is one of the most interesting, most flexible set of instruments that any multilateral development bank has. And I think it could be argued that much of what the MIF does is impact investing. I think we'll get into that. And then we also have David Wood, who's the director of the Initiative for Responsible Investment at the Hauser Institute for Civil Society at the Harvard Kennedy School of Government. And he's flown in from Boston to be with us, and Saadia has kindly come in from New York. So I think David gets the award for making the longest journey to be with us today.
It's not very long. It's like an hour.
Right, exactly. So, but thanks. I really do. I think we've got a great panel to unpack these issues. So I'm going to ask my friend Elizabeth to start on. I think you've been watching, Elizabeth. You had a past life before you were the CEO of OPIC, running CGAP, which I've always described as sort of the Major League Baseball Association of the microfinance world. Or I would say the FIFA in this audience, but there's some brand problems with not anymore. So we're going to stick with the Major League Baseball Commission for microfinance. So you've been watching this for 10 years, and then you also had a past life in investment banking as well. So thanks for being here.
Thanks so much, Dan. And for me personally, it's super exciting to be here, not only because, of the work that OPIC does in 150 countries with a $20 billion portfolio now. This is definitely my favorite stuff. And secondly, because as I look around the room, I see not only old friends, but lots of, bright new lights. And I know that it's this crowd that's going to make impact investing, mainstream, part of financial decisions, part of stock tickers, part of rating agencies, part of everything that's done in the financial markets in the decade to come. So it's exciting to be here with all of you guys, and very humbling too, because you guys are the ones that are going to make it happen. So I thought it would be useful just to sort of step back and look at the phases as I've seen them and how this little impact investing world has evolved over the last 10 years, because it's really been an extraordinary set of steps. In many cases, it's ones that parallel the microfinance field. So first of all, in the last 10 years, I think the growth has been tremendous. And anyone that thinks it's anything less than incredible doesn't get the revolution that is happening with all of us. It's been huge. So in the beginning, of course, there was a sort of a clubbiness to it. Rigid parameters. It had to have intent. It had to have metrics. And it was a little bit clubby, kind of like the microfinance field was in the very beginning. And that was important because people were working on dealing with the fact that people's brains were bifurcated into profits and charity. Societies were bifurcated and distrusting of one another on those two sides. Regulatory frameworks are split. So it was working to believe that you could actually do both at once, and that was very important. That first sort of narrow clubbiness and definition to it, and labeling it impact investing, much to the chagrin of the SRI community, which didn't like it so much in the beginning. Then came, of course, the inevitable hype. They were what I call the breathless maximizers that said this is going to be trillions of dollars, it's going to take over the world, it's going to be part of everything we do. And of course, having made those huge claims came the next step, which is the backlash, the derisive minimizers that say, this is nothing, it's never going to matter, people care about profits, you got to be kidding. And for me, to those groups, I would say, actually, the $14 trillion of global capital markets isn't what's important. What's important is the paltry $135 billion of global foreign aid. If we can get impact investing to come close to that, then we really have deflected capital to something that can be done sustainably from something that was done with scarce donor and taxpayer money. So the breathless maximizers, the derisive minimizers, it was in that OPIC did its call, but I'll come to the OPIC business later on. And then, of course, comes the arrival of the mainstream, and we had a really interesting panel earlier, I thought that was very stimulating, but which is emblematic of kind of the arrival of all the mainstream players who, in my view, at long last have woken up to the latent demand of retail for values-driven investment. And they've come to the table now, and they've sort of looked around and figured, okay, how can I play here? And what they found is they can't really play easily because of the ticket size, because of the lack of liquidity in the market, et cetera, et cetera. And so there was an inevitable backlash there of saying, well, these guys, these mainstream, these Morgan Stanleys are just doing old wine in new bottles. They're calling it impact investing, but it's actually diluting what we were trying to create here. So that was the next stage. And now I see we're actually arriving at a place which is much more inclusive and broad and recognizes that, unlike, I think, that chart that was up there earlier, it's not a two-dimensional matrix between risk and return. It's actually a multi-dimensional matrix. It has risk and return and impact, both negative externalities as well as positive impact, and allowing everyone to choose kind of where they want to be in that matrix, on that spectrum, where their strategies, their personal preferences, what's important to them in terms of stability of returns, value of returns, types of returns, country of returns. And so that, I think, is allowing a much more inclusive, open, and exciting world in which everybody, regardless of their institutional parameters, can play and can participate. So I could go on and on about that, but since this is about donors, I would just say one last word, and that is, you know, people have felt it was sort of sexier to talk about, to speak, a private sector driven model of making the world a better place. But the secret has been, and I think we'll touch on that, is that according to the Gin and JP Morgan reports, frankly, the public sector, DFIs and others have been almost half of the capital that's gone into it so far. So we want to stand up and be noticed, us donors, because we get too often kind of pushed aside. It's not really about the donors. We want to hide them in the back room and focus on the cool private sector. So we're here to stand up and be taken.
Well, I'm glad that I have Elizabeth by the side.
So Saadia, Rockefeller's had a very interesting, made an interesting contribution to the field of impact investing. Thanks for being here.
Thank you.
Tell us a little bit about that.
So I was thinking about this yesterday on the train ride down in terms of, you know, how would I describe the journey? And it kind of hit me that maybe it would be better to start with why we started off on the journey to begin with. Because if you don't have that context in mind, then talking about finance and financial instruments and money doesn't really make that much sense. And the way we look at it, I mean, we really live in the times where there is so much change and complexity out in the world. Whether you want to call it the era of the new normal or you want to call it something else, but there are so many, the severity and intensity of the economic shocks and stresses, the environmental shocks and stresses, the social shocks and stresses are just increasing across the board. And I think if we just look to the last couple of years, the kind of crisis that we've seen unfold globally, whether that is related to climate change and the disasters there, whether that's related to the Ebola crisis, or the one that's currently unfolding, which is the refugee crisis. I mean, that is what we're dealing with. And there's also a recognition across the board now, increasingly, that the institutions we have, the instruments we have, and the funding solutions we have to actually deal with these crises or shocks or stresses just cannot keep up with the demand out there, with the need out there. So there is a need for new thinking. One of the things that struck me it was back in December, was I was reading an article, and the then UN High Commissioner for Refugees basically described that part of the system as being financially broke. If you look at the need that was related to the refugee crisis or the appeal that was made last year, it was for $5.5 billion. And that is just to deal with the situation in Syria and the countries surrounding Syria. That doesn't even cover what happens outside of that. Only less than 40% of that money was actually forthcoming. So I wouldn't go as far as to make, a depressing statement here saying that it's financially broken, we need to do something with it. But the reality is the plans we have, what we want to achieve, we just don't have the financial means of getting to that. We can look at the SDGs and the number that was attached to that. I think the number changes over time, but the last I looked at it, there was a funding gap of $2 trillion annually just to deal with the need in the developing world. That's a huge number, and that's a number that, to the best of the abilities, the foundations and the DFIs and the donor community at large cannot deal with, so there is a need to engage with the private sector. But the private sector isn't going to jump in by themselves, and that's back to what Elizabeth was saying as well. We have to come together and figure out what are the kind of solutions that we can put forward, and how do we do it in a way that lives up to our expectations, that lives up to the private sector's expectations as well, because where there used to be a divide, that divide doesn't exist anymore, or at least if it continues, we won't get to where we want to get to. So that brings me a little bit back to what the foundation has been doing in the past and continues to do, is a broader focus around what we call innovative finance, which is how do you create scalable, sustainable, effective solutions for getting private sector funding engaged in the development sector to address social challenges, economic and environmental across the board. And given the mission that the foundation has, our focus is global. So it's not limited to just the developing world. We are equally interested here in the US or in Europe or other places where there is a need as well. Now, if I take that and say, unpack it a little bit, I was not so surprised about the conversation that was happening on the previous panel, but at the same time also thinking we can't just stay there, we have to go beyond. We're not going to get to solving those problems just by focusing on social enterprises. They're a very important part of it, but when we think about who can bring about the change, we have to think about the private sector as well. We have to think about the NGOs. We have to think about the public sector. And there is a funding gap and a funding need across all of those actors, social enterprise still being in there as well. I also think we have to think much more broadly about the kind of financial solutions that we're looking at. And it was touched upon a little bit in the previous panel, the private equity model, some of the other traditional things, they're relevant, they'll continue to be relevant, but for us at the foundation now, it's about a much broader, expansive set of solutions that spans from insurance products, which have an important role to play, to debt and equity products, to even micro-taxes. They're not market-based solutions, but it is a way of bringing the private sector resources to bear. And yes, the holy grail remains money, institutional investors and all the capital that they have there. But again, there are other investor groups out there as well that continue to be relevant. The question is more, how do we come together to form those partnerships and create those solutions and open up new markets so the money can flow? So just the short version in terms of the journey, we typically get associated with having funded some of the work that led to the architecture for the impact investing world, and that is true. That is what we did starting back in 2007. We hosted a conference at a conference center in Bellagio where the term was even coined of impact investing. We went on to incubate GIN, that was mentioned in the previous panel as well. We've supported B Labs to do the great work that they're doing. We also funded some of the work that supported Gears and Iris. And then with our innovative finance, portfolio now, we deploy both our grants as well as our PRIs to try to come up with the new solutions and new partnerships. And we've done a co-investment project with OPIC that we will talk maybe more about later. We were investors in the very first social impact bond that was piloted at Peterborough Prison in London, and then there's a whole host of other things. So that part of the journey, I think, started way before 2007, and there's kind of no end date to it as where we sit now.
So if you're smart, you're going to ask Saadia how you get an invite to Bellagio, which is this fabulous mansion in northern Italy, where actually very serious meetings happen. I've been fortunate to go once, and so I do think that they're very powerful conversations and very impactful conversations that happen at a place like Bellagio. So it'd be very nice to Saadia. I plan to be, so hoping I'm getting another invite. But Julie, thanks for being here. I really do believe that if I look at the MDBs, that in many ways the Inter-American Development Bank has the most flexible instruments of any of the MDBs, partially because of the multilateral investment fund, but also because of initiatives like Opportunities for the Majority. So I really appreciate you being here. You had a past life in investment banking as well, and so I know this is something that's in your inbox right now. So thanks for being here.
No, you bet. And hopefully what I'll say will build off of both what Elizabeth and Saadia said, which is, all of that evolution that we've gotten to today, I think can then be looked against the backdrop of the Sustainable Development Goals, as Saadia was saying, where, as the MDBs a year ago, we put out a paper that said, how do we get from billions to trillions? Because that $2 trillion a year gap is actually without taking into account climate change, which we all know is another really big number, right? So to take everything that has been done so far and to take the conversation that happened earlier today and to think about what it means to get from billions to trillions, I think you have to talk about the bottlenecks that exist today and how we overcome some of those. So part of what we're talking about is all about infrastructure in the developing world. It's about how to create access to markets. So if you're stuck in the world of I only think about impact investing in this very narrow way, well, then there's no space for that and calling it impact. And that's a lot of money, and a lot of money that needs to be mobilized. And probably there is where one does have to find ways to bring in institutional money. Because A, the numbers are big, and B, it's where there are big tickets, which is what institutions need in order to come into the market. Then there's the question of, we call it patient capital, but how patient is patience? And when you're dealing with different parts of the market, retail markets, can you really talk to somebody about something that's locked up for 10 years or 15 years? And so finding ways to address liquidity, even amongst those who think they are patient capital, becomes a really big deal. And we're doing various things at the IDB to try to look at that problem. And I skipped in the first problem to bring in outside institutions. It's clear that many of the institutional investors will only look at certain parts of that risk spectrum. So we as MDBs, we know that our money takes risks that others won't take. Institutions are not going to take the risk of construction of the Metro de Lima or the early operating risk. But once that's over, there's actually a really interesting and attractive 15-year piece of paper with very stable returns. So now, how do you get them to come into some of these markets? You bring in local pension funds. And that's some of the work that comes out of the things that we've done so far. Ease of investment, and that came up earlier too. Ticket size, and how do you get the investments, and does it take tons of people doing all this analysis? Well, that's another place where the different institutions who actually have a lot of resources, and in our case, we have 26 offices in 26 countries in Latin America and the Caribbean with people who look after these investments every day, all day. If we can find vehicles where Rockefeller and others invest alongside OPIC, or we launched a vehicle recently where Calvert Foundation is investing alongside us on a deal-by-deal basis in a pool, then you start to overcome that hurdle. And the size per investment by creating a pooling effect and by creating more funds and funds of funds that can get to the size issues. And then, then there comes this overall question of pricing. And is there a cost and a return impact here? There were a lot of different views expressed in the previous panel. I look at this as impact doesn't come for free. That doesn't mean that impact doesn't have return. And there were folks who said, no, you can have all the impact in the world and you can have a totally market-driven return. We have no idea what's going to happen in the future. And, some of those charts imply that we have a crystal ball. Elizabeth and I were talking last week. If you had had a portfolio made up of microfinance investment vehicles in the 2005 to 2010 space, your return would have been better than almost any other way you could have invested, because talk about stable, right? And so you don't know what the future is going to bring. But in general, in order to create impact, there is investment that needs to be made. There are trade-offs that people have to make. And so there is this spectrum and a matching of instrument and return that people have to think about. It's instrument, it's impact, it's return. And I think that the important point there is that people know what they're attempting to achieve and their expectations are clear and what they're being offered is clear. So if we have a big tent approach and we have some people who have negative screens and some people who think that, if I'm creating access to markets and an infrastructure investment, that's impact, no question. But it's got a different feel and a different kind of impact that's being delivered than I'm providing energy at the bottom of the pyramid to rural producers, right? And so making sure that we're able to match instrument, expectation, and outcomes and measurement is another big hurdle that has to be overcome. And I think all of us we're doing things that we hope will be able to help address that. So those are some of the buckets I think that we have to get through if we're going to take the $60 to $70 billion of impact investing, as John mentioned, and be able to move toward the $40 trillion, which David was talking about, which is basically is negative screen money, and how you move along that continuum and move more of it from one direction to the other.
David, thanks for being here. We had an interesting conversation prior to this talking about the trajectory of either the asset class or the phenomenon or the field. Could you talk a little bit about how it's evolved from your perspective, and also what are some of the things that are what's holding it back in terms of the growth of impact investing?
Sure. So I took notes on the first panel on my phone.
He's really emailing.
These are my notes. I'm not checking my email.
I don't believe it.
Apparently somebody got in trouble at the Golden Globes for doing this the other day. I'm nervous. And most of my job, so I work at a research project. We're grant-funded dilettantes at the Kennedy School, and we have our, we eat from many different plates. I work with pension fund trustees thinking about big systemic issues and ESG issues. We work with foundation endowments, increasingly with high net worth and family office, who are trying to target specific social impact. And then we've spent a lot of time on public policy and actually a lot of place-based work on investment readiness. So touching on the supply of capital, but also the demand for capital across a variety of issues. And most of what I do is go around telling other people what Elizabeth, Saadia, and Julie do. So I'm a little superfluous on the panel here. But I thought I'd make 4 points. Yeah. I mean, one thing, so the way this world has changed from my perspective, I have, so we talk to responsible investors, institutional investors who say ESG is really important to them. And we talk to impact investors who say we really want to target this outcome and create it. In 2007, at that first Bellagio meeting, the ESG people, they didn't even appear. And the UNPRI was being launched in 2006. They were two totally separate communities. That first panel, you heard that integration and people working together, that's new. And it's exciting, and it's a moment where we're trying to figure out how to put them together. On the other hand, if you went to a series of responsible investors and told them all they did was negative screens, they would flinch. They would have, they almost would have thrown their drink at you, Julie. So
We're amongst friends.
Yeah, no, I get it. I get it. So you have this kind of, there's still differences in approaches, but the convergence is much more dramatic, I think, than the divergence these days. And I thought my notes are 4 points that I thought I'd just make about sort of that trend for the last 10 years. One, what unites these two groups, I think, is a critique of how markets work today. Like, there's a vocabulary problem. Everybody says that nobody understands each other. But essentially, everybody who either cares about long-term financial returns and the impact of environmental and social issues on them, or who is trying to create social impact, believes that markets are not serving society as well as they might. If you believe that markets are socially efficient, you're not in this room, problem. And that is an important piece of this convergence. But there's also a tension embedded there. When impact investment started, it was about how can we take the genius of Wall Street and apply it to social problems and bring new resources to these intractable problems. And then the market blew up. And then impact investment was how can we fix structurally this flawed system that's not serving society as much. The language is very, and it takes two tacks. One is finance is super powerful and a great tool to create impact. And two, finance is not serving society as well as it might be. I think that's led to, interestingly enough, sort of in 2016, we're seeing lots of talks about systems. Systems changed. UNEP-FI did a great report called Towards a Sustainable Financial System, where all of the impact investment and responsible investment language was rolled up into a systemic analysis of how finance works. I think that's a little new and different, and probably is related to the development conversation in ways we haven't fully explored. Secondly, I've been in the business for 10 years. I'm a historian of 17th century Spain by training. I should have said that at the beginning so you could discount what I'm about to say.
So are we in a golden age of impact investing?
Yeah, no, we're actually squandering all our money from that's coming into silver from the New World. Sorry, let's not go down that path.
Sorry.
I think the guy who brought me into this field was an experimental playwright, knocking on doors in the 70s looking for a day job to fund his. The field attracted people like us because there was no field, right? I couldn't get the job I have now because we have graduate students who are doing this work. I teach a course and they come and take it. That's been a real change. And in the same 10 years, what we've seen is a real dramatic change in investor interest. I think this client demand that we heard from Ami before it's real. I was reading your interviews with Jin on the way down, which were great, but then I realized I had nothing else to say. It was distressing. But it's just different now, the amount of client demand that's coming up, and people don't know what to do with it, but it's there. And we've seen that change. And same on the pension fund side. And European pension funds have allocated to impact investment. That's relatively new. Where they're going to put the money is still a mystery. That's point number 2. And we're really trying to work through the kind of things that Julie was just talking about. Point 3, I think in the US domestic impact investing market, foundations have played a very central role as early investors, but also as field builders in the global market. The stuff that you all do as DFIs, it makes the market. We're seeing the role of these institutions change as that new investor demand comes along. Where it used to be, we're just going to find ways that we can invest our own money to create impact. There's much more of a sense of field building and of systems reform and of product development that's meant to attract and channel this new money that's notionally on the table. And I think institutions in development, foundations in the US and elsewhere, but also public policymakers are wrestling with what it really means to build channels for this money so that it has public purpose. Some of this is a measurement question about how to generate public purpose. Some of this is a product development question. But I think there's also, and this is my final point, a real ethical question about when private market capital is the right solution for the social problem you're trying to resolve. And I think of this really with the development of the SDGs and ADIS, where this kind of talk about, we've got to engage the private sector because we don't have the money. That's not good enough unless we come up with products that actually deliver on their social promise. And domestically, the social impact bond conversation, it became for a little while that hype, piece that Elizabeth was talking about. Every problem needed a social impact bond. Well, it turns out they're not actually useful for every problem. And we really need a system. I'm thinking as a quasi-academic researching this field, we need a system to review the SDGs, say, and to figure out where the appropriate problems are, where private finance is the right solution, and then to tackle the product development side, rather than just throw up our hands and say, well, we don't have enough money, so we need to reach out. And I think the people on this stage, not me, I study what they do, but they're working on that sort of ethical question as well as the practical questions, and sometimes it falls to us who are outside the system to kind of raise those up for scrutiny.
Thanks a lot. I'm going to ask each of you to take a crack at how you would define impact investing. I don't necessarily ask you to have a precise definition, but maybe your take on what you mean by impact investing. So Elizabeth, is everything that OPIC does impact investing?
It's interesting. I wrote a little blog called I Have a Confession. I was totally wrong about impact investing for the first 6 years we've been looking at it. Because I guess I've come to believe that insisting on the intent piece, as well as the metrics, is kind of misguided and that metrics can be a very good, maybe even a better proxy for intent than a claim that I really want to solve a social problem. So one of our private equity partners mentioned to me a year or so ago, maybe we should just drop intent and double down on metrics. And I think that's a very provocative, I've had a lot of backlash from friends who've been in the field for a while, but I think that's actually something we should think about and maybe hear people's reactions in the room. So in terms of definition, on one hand, in the narrow definition, $330 million of what we did last year is social first impact investing, a very big number. I like to think that the $4 billion we did of roads and bridges and power plants and low-income housing in really difficult markets, most of them are in the low-income countries of the world, it's impact investing too, damn it, you know? So I've kind of come around to believing what I said earlier, which is, you know, actually the great thing about where we are now in this field is everybody gets to choose. If I'm a high net worth individual and I care a lot about jobs and I want to make a modest return, that's fine. Just say that's what you want to do. Tell it to your financial advisor, ask for decent metrics, and track them on it. But if you care about maybe getting a lot of upside, maybe a microfinance investment vehicle is right for you. So I think we're really arriving at this kind of opening of the clouds where everybody gets to choose how they want to make the world a better place and what kind of return they want. Do they care about long-term stable returns? Do they want to reach for the golden ring fast? So I think it's kind of wonderful. And the last thing I would say on this is, you know, I've heard people say, well, you know, 8%, come on, that's not private equity, that's a below market return. Well, frankly, if the financial crisis taught us anything, it should be that low stable returns is preferable to high and short-term ones. What's wrong with 2 and 3%? You know, some of the studies that were done, I think it was the Kaufman Foundation did a study of venture capital funds and showed that less than a third of them even made money after return of fees. So I think we need a level set with the financial world about what a realistic long-term return is, and a much greater appreciation and valuation for stability against volatility, which has frankly been the hallmark of microfinance funds. And let's start valuing stability, not just short-term returns.
Saadia, how do you talk about, when you talk, I mean, you guys helped set up the field and you have this larger construct that impact investing fits within, so how do you see impact investing?
For me, at the end of the day, there's so many terms, there are so many different ways of slicing and dicing it. At the end of the day, it has to do with money. It has to do with more money, better money, sustainable money, and bringing that money into serving development goals or purposes, right? When we did the early work that we did around the impact investing architecture, there was a very strong focus on intentionality. Intentionality to have a social impact alongside a financial return. And the focus then also was primarily, as I mentioned earlier, on social enterprises as the means of achieving that on the ground. We now talk a lot about innovative finance at the foundation, and that's how we frame the work that we do. And we see impact investing as being a part of it. Because I would want everybody to care about the things that we care about. I want everybody to say we need to solve for climate change. I deeply personally care, and let's do something. Same with all of these other crises. Reality is that's not how people, institutions, organizations, whatever layer you want to slice and dice it at, work. We don't all care about the same things, and we won't all put our money forward for that reason. So what we're doing now with our innovative finance portfolio is to say we're trying to create the solutions that would be attractive regardless of intentionality. But when I go back to the impact investing and where the field started, intentionality, both on the social side and the financial side, was an extremely important part of it.
Thanks. Julie, so is everything the MIF does, the Multilateral Investment Fund does, or the Inter-American Investment Corporation, which is the IFC equivalent, DFI equivalent at the Inter-American Development Bank, is everything that the MIF does and the IAC does, is that impact investing?
No. And I say no because I do think, and Elizabeth and I worked together in the Let's Define, and we both went through our portfolios, I don't know, almost 2 years ago, and said, what at the core fits the narrowest definition of impact investing? And Elizabeth's number was that. And we had a portfolio at the time about $7.5 billion, and a little over $1 billion of that was in that narrow definition. But the entire $7+ billion was what we call development finance. All of it had an impact, right? But not all of it had the upfront intentionality that was required under the narrow definition. And I, like Elizabeth, believe that everybody's entitled to their own view of this. You just have to be clear as to what your counterpart's trying to get at so that you're matching that intent. But why else do I say not everything that the MIF does or that the IIC does is impact investing? Because the MIF also makes flat-out grants. One thing that we're pretty clear on, and I'm pretty clear on, is if you want to call it impact investing, there is some concept, regardless of where you are on the return spectrum and where you are on the impact spectrum, you're on the return spectrum. The intent here is to have things that are sustainable. So when I give a grant, that grant itself isn't an impact investment. It might mobilize impact investing. It might allow an impact investment to exist, and we might be the investor along with other people, but it itself is not an impact investment. And we've done a lot of investing in the fund space, venture and funds that are oriented toward the environment. And we have some great stories to tell there, but none of those would have happened, or most of those wouldn't happen, I suppose, without some grant money that helped those management teams and funds get to a point where they could present themselves to the market in a sustainable way. And today, we were an investor in a fund called Eco Enterprises, and the first fund, I think, was $15 or $20 million. And Nature Conservancy originally was one of the co-sponsors of this fund. Now that fund has grown up, and it's got a management team that really knows how to invest. And Fund 2 was around a $35 million fund, and it's got 12 to 15% rate of return now and looking forward. And Fund 3 is in the market. And Fund 3 is going to have a first close of $50 million, and it's targeting $80 to $100 million. And the Jeff is investing $10 million in that fund, and other market investors are investing in that fund. So, there's this spectrum and instruments, and I think we believe you can have a conversation that allows everybody to participate. You just have to have clarity around what it is.
So how would you define impact investing, or when you're in class doing impact investing 101, what do you tell people?
I say it's all the same stuff. I'm a lumper and a big tent person too. I think there's a sort of variety of ways people are acting in order to use their financial instruments to make the world a little bit better place. And there are different ways you can go about doing that.
So you're not too worried. We shouldn't spend too much time on the theological debates about how many angels dance on the head of a pin on impact investing?
One thing my wife's dissertation advisor used to say, words and things are not the same thing. And when we fight over vocabulary, we want to make sure we're fighting over the things and not just the words. So we've just spent a lot of time fighting over the words, but not the thing. I do think there's a field within impact investment, this kind of R&D function for how to do things differently in order to create greater social impact. What you just described with Eco Enterprises was R&D that will bring in new investment. And that's a different activity than just looking to be on the right side in environmental and social macro trends. And I think what we call impact investment is often this kind of R&D function for broader financial markets. And that's maybe a useful way to think about what the tip of the spear looks like.
Okay. So let me just, I want to shift a little bit and talk about the role. If I think about an organization like USAID, which has probably 80 field offices, or the Inter-American Development Bank, which has 26, or I think about the World Bank Group, either IFC or the main World Bank Group mothership, I'm guessing they've got north of 80 offices as well. Let's just say, for argument's sake, it's 80, or let's say 100 plus field offices. And I think about a number of global NGOs, a World Vision, a Catholic Relief Services, it could be a CARE, it could be a Save the Children. They have 60, 80 offices around the world. These organizations have significant access to deal flow. There was some discussion about the access to actual opportunities. So if you have a fund and you're sitting in San Francisco, I actually think it's fairly hard to actually access some of these things. And if you don't speak Portuguese, or you don't speak Wolof, or you don't speak Arabic, and you haven't been to Ouagadougou recently, you may actually not see all that many deals. So I do think so I want to get at, one thing which I want to hint at is that there are a number of these sort of both official donors and social sector organizations that have, let's call it, unique reach or access, but may not have the right sorts of instruments. And then, and could you talk a little bit about how donors or social sector organizations, what role they play in this? And if I could just push just a little bit further on, if I think about an AID or an Australia aid agency or a DFID, what's the role of bilateral aid agencies in particular in the conversation around impact investing in particular? One aspect of it is their field reach, but I'd like to talk a little bit about some of these specific grant instrumentalities and what role they have to play. So maybe Elizabeth, let me just start with you in terms of either how you're either working with social sector organizations, either in deals that are coming to you at OPIC and or how you engage with other bilateral donors. It could be the World Bank, it could be AID, it could be DFID. How do you come across those organizations from where you sit now or even in your past life at CGAP?
So Dan, I think you're touching on probably the single biggest culture change that needs to happen to make impact investing live up to its potential. Because I feel like the world now sees a problem and they think, okay, here's a problem that the private sector won't do on its own, so therefore the public sector or grants should solve that problem. Very few people have the latitude to think, what's the smallest amount of grant money or taxpayer money that can be brought to bear to crowd in the maximum amount of private sector money to solve that problem? Everyone's in their own channel. The aid people think about aid, the private sector folks think about private sector, and it's that blending that doesn't happen as often as it should. I think the MIF and Rockefeller have been notable exceptions in that, and I really celebrate the work that you two have done on that score. But if you match that kind of observation about the bifurcated world that we live in with probably the number one challenge that the impact investing field faces, which is the lack of continuity of types of capital along the evolution of a given project. The famous pioneer gap, which Monitor and Acumen and others have spoken so articulately about, where the early stage investors just don't have the capital. So I really, the idea of philanthropists and grant makers putting their capital to work in a way that leverages in other people's more commercial capital, like DFIs, that then becomes the bridge to the private sector is a schema, whatever the French word is, that I think needs to be more celebrated. But right now you have most of the philanthropists and the grant makers feel this kind of a sense of ownership. They want to own the project. They feel it's kind of culturally wrong to give it up to somebody else to lift up and grow. They don't want it to go away. They don't want to create a pipeline for somebody else. So there's a lot of competition and kind of badness in the relationship between these actors that I think needs to go away. One of the ways that, just if I may say, that OPIC has tried to address this pioneer gap or this problem within our own toolkit, which I might just note is more limited than any other DFI in the world, since we are the only one that has neither a grant instrument, which I don't want, that's for AID, thank you, nor an equity instrument. So it's challenging for us to do that. But we have done a few things like take a chunk of our capital and put it aside to back a portfolio of much earlier stage, much riskier projects. It's called the Portfolios for Impact, which never would have met our underwriting criteria ordinarily. And this has been actually so far so good. It seems to have been very successful. We've had about 40 applicants. We've approved about 7 and one's dispersed already. And these are small projects that we think have a chance, but we couldn't do as a development finance institution ordinarily. So we think that's promising. We've created a number of other windows that I'm happy to describe later on that may be of interest to those of you in the room.
Thank you. Julie, I know you have a view on this.
Yeah, so and I sit here as the EVP and COO of the Inter-American Development Bank, but I'm also on the board of the MacArthur Foundation, which has also been an early impact investor, PRI investor, MRI investor, however you want to, all the different tags you can bring to it. And I think something that Elizabeth said is really important there, which is a bunch of people who really don't want to let go versus, I think people who've been doing this for a longer period of time, the actual goal is to put as little money as possible into anything to leverage as much money as possible and to get that money out as soon as possible and move on to the next thing, right? Because we all know we don't have enough resources to do everything we want to do. And that's kind of where I see your question going to. So I mentioned earlier a platform the IDB recently created with Calvert. And it took $2 million of IDB group money as equity in this platform to get $18 million from Calvert's investors who come in off an internet platform at $20 increments, right? I mean,
So I can go online today.
you can go online today and you can invest, right? So there's $18 million that is investing side by side with us as we do deals. So people are investing in a financial institution in Colombia that is specifically focused on lending to low-salaried civil servants, members of the military, and a couple of other categories. There's another investment in there that they've already made with us, which is a provider of student loans to low-income people in Mexico, right?
Great.
So the money that's going into that, 14,000 students in Mexico, who are generally the first in their families to go to school, et cetera, right? So, and our goal
What's
is...
the website?
It's actually, if you go to Calvert Foundation, you'll find the link to the website because one of my colleagues is here.
What?
Vested, right.
Vested.org.
Yeah.
Go to vested.org.
Thank you, Vested. Because
Call
I
now.
tend to say it wrong.
You can do it on your phones.
You can do it on your phone. I want everyone to take out their iPhone.
Right, and what's our goal? Our goal is that we fully invest that $20 million, and then more equity comes into the portfolio, and then more money comes in off the platform,
Great.
and we're rocking and rolling. And similarly, and I should say, the money has a hurdle. I mean, it's intended to have, on average, LIBOR plus 450 as a return at a more or less a 5-year maturity. We have a whole portfolio in the IDB that we've had built over the last 5 or 6 years. It's debt. It's got rates of between LIBOR plus 3.5 and LIBOR plus 6. It's got an average life of 5 years. It's got about a 4% arrears rate. So seeing that and investing in some of those deals, Calvert was able to see, hey, this can work for us, right? MacArthur is looking at this and saying, okay, people have an issue around getting the pieces that others can't get. So first loss guarantee or partial liquidity guarantee. And that's another thing the IDB is doing. So if you put that in, then others will put in risk capital that looks more like risk capital, but they won't do it without something. And again, massive leverage on your money if it works. And so I think that this is really the point of you've got to people have to take a view of what do I do to bring in the most amount of money? And I'll just give one other example. Huge study done by Moody's about all the infrastructure financing around the world. And the actual default rates in the developing world versus what people perceive. Massive mismatch between perceived risk and actual risk. Well, when that exists, commercial insurance companies can actually create a product and make money. Right? But no one had brought it to their attention. So either somebody like us has to put our money in as first loss money and mitigate that risk, or we actually bring commercial people who are good at doing this in to do this and move our money into something else. So those, I think, are huge opportunities for us to actually get more money leveraged in, take your name off the door. It doesn't matter who gets credit. It's getting a solution to the problem.
Okay, David?
I was going to say, I mean, it's not just more money, though, right? It's also what that money is directed to.
Oh, no,
And
absolutely.
this is not you were saying that.
Right. I was given the earlier part of the conversation. I was taking that as a given.
Totally, but I think one of the other things that you're trying to leverage, and just to go to the grant function, part of this is using the grants in order to create the products that leverage in other people's money, but it's also to direct the money towards higher social value.
Absolutely.
And we've been doing a lot of work on infrastructure investment. And it turns out the conventional way that projects are developed and the pre-development functions don't lead to the highest social and environmental value of infrastructure, to say the least.
Exactly.
And the grant money, so we've been working with NRDC and the Ford Foundation, but also have talked with Rockefeller a lot about this. The grant money that can go to places for the pre-development phase so that you can break silos between environmental goals or include targeted investment in social areas, engage mixed use and mixed income housing. Your transit is a big topic in the US, but there's a lot of work on the ground to make projects surface up and become investable that will then attract that kind of money. And that's where the grant money can go, and then the concession can come in the guarantee, and then you can leverage it other people's in our happy utopia that doesn't exist.
Can I just say one thing on this, Dan,
Yes.
if I may? I think that's a super important point. And one of the things that I've noticed is that sometimes people have a fairly simplistic view about leverage. Like, I want to drive down the smallest amount, which both of us said actually, but I want to put a caveat on it. So if you can say I'm leveraging $10 of private capital for every $1 of grant dollars, that's better than leveraging $2 of private capital for every $1 of grant dollars. But it's actually not the same. That's indicative of the risk you're taking. So what we find is that we can't claim OPIC to be leveraging $20 of private capital for every $1 that we're putting in, because we're doing business in places like South Sudan. So sometimes you need 50% first loss, or even 75%,
Sure.
you know, grant money to start bringing in private capital. So I just think we need to create another dimension, if you will, which is the risk factor that actually will drive how much leverage you can get on your grant money or on your public sector money.
The risk and the impact.
Exactly, yes.
So Saadia, tell me from your perspective how you see the either the nonprofit sector or the official donor world, how you see their roles in the impact investing space.
So maybe I can talk about it in the context of what we're doing
Yes.
now and give a few examples of how that comes together, because it does all need to come together. So what we do now is grant funding for early stage R&D and design of new solutions and mechanisms that have the potential to attract money from the private sector as investment capital. Everybody talks about innovation, everybody wants to do it, but the money available to actually go out at what seems to be a far out idea and get it developed isn't there. That's where I see foundations as having an extremely important role to play, because we have that type of capital that we can bring to bear, right? We did that with social impact bonds. We've done it with something I can give as an example, called African risk capacity. And we're continuing to do it with everything that we have in our portfolio now. But it's not enough that we give the money at that stage if we haven't already established partnerships and gotten some interest from other people in the field to come in and be part of it once we have proven the initial concept somehow. Now, that includes donors, that includes DFIs, to lesser extent, private sector investors, the institutional side. Sometimes they come in right away, sometimes it takes longer time. But what we do now is when we go in and fund something, part of the process of getting it designed is also having the conversations of what do we do with it to get it to the next level, whatever that next level may be. I'll give African risk capacity as an example. It's something that the foundation has been involved in for a long time. And that's more than 6 years. There was a conversation that happened at one point in the World Food Program around Africa as a continent is extremely vulnerable to natural disasters. We should be able to have a view on what those vulnerabilities are and what the economic costs associated with those are. So we funded something called Africa Risk View, which was a tool just to understand what those vulnerabilities are. It didn't have anything to do with financing at that point of view. Once you had that in place, then the question was, okay, how do we then get the funding to do the things that need to be done? Because the way the humanitarian system works is post-disaster. So a disaster happens, whether it's flooding or drought or something, then you wait, you make an appeal, then the money slowly trickles in. The situation gets so much worse on the ground for people, for institutions, the whole thing. So it was like, if we have a view on what those vulnerabilities are, what are smart, intelligent ways of then also lining up the financing that can work? And that led to the creation of Africa Risk Capacity Insurance Limited. And it's a mutual insurance company where the member states sign up to buy insurance, and it's pooled risk insurance. But that's not something that the foundation could have done alone. There are many other parties that have become part of it. So it's now a specialized agency of the African Union. It wasn't initially. There are many donors that are part of it, DFID, CEDA, KFW. I mean, the list is long. The role that they play is different along the way as well. And then you have all of a sudden also a great platform that you can continue to innovate on. So we have a grant to them now where they're looking at something called the Extreme Climate Facility, which is probably more, it hasn't been finalized yet, it's in the R&D phase, but it's to say for the very extreme events that happen, that pool risk insurance that's in place won't cover it. So what's the right approach for accessing money that allows you to do adaptation projects and not just managing the one crisis? And it'll probably end up being a series of catastrophe bonds or could take another place. And there the question is, if you already have countries that are paying for their own insurance premium now, which is the case, they might not have the capacity to go in and sign up for the Extreme Climate Facility. So is there a role there for donors to play, the DFIDs of the world, to pay the premium there because they know at the end of the day it'll have a bigger impact at the right time for a larger group of people. So that to me is an amazing, and that's grown to be this great platform, and they're also doing something around outbreak and epidemics now. to say, how do you make the countries own the project and then bring in the entire community around it to actually make it happen? Because that couldn't just have happened with Rockefeller Foundation support.
Okay, so the head of AID, the head of the foreign minister of Australia, which now runs what used to be AusAid, the junior minister in Canada, which used to be CETA as part of the Ministry of Global Affairs, and the minister for DFID, Justine Green, all happen to be women, by the way. These are these four aid agencies. So if you had any of these four folks in front of you, and they have big grant checkbooks, they write large grants, they could have flexible money. In some ways, you could argue they could be the most flexible money that's out there. And if I said, okay, if you had a conversation with any of these four women who can write $50, $100 million, $250 million checks, what would you ask them to do if they were here? What would you ask a bilateral aid agency in terms of if you had money in the impact investing space in the developing world? What would you ask them to do with their money? So why don't I start with you, Elizabeth?
Very clear. I would ask them to put aside $100 million for the explicit purpose of leveraging in DFI capital that would then leverage in commercial
It
capital.
would be in the form of first loss?
First loss.
Okay, so if you ever have to go back and Google the concept of first loss, but I think this is a critical existential concept for the discussion around impact investing.
And first loss is equity. It is another person's equity, just as profitability is another person's financial sustainability.
Yeah.
Some are bad words
Yeah.
and some are good words, but they
Okay.
mean the same thing.
So, okay, so $100 million, so, okay.
Can I just add to this?
Yes.
One of the amusing things about that is I would say to one of those agencies, one of the predecessors of one of those ladies, I said, they were coming, I was working with them in Afghanistan, and I said, why don't you just, rather than making grant money into this thing we were talking about, why don't you put equity money in, and then you could, leverage in us. And they said, no, we could never do equity. It's much too risky. And I said, wait a minute, so in one case, you're for sure going to lose everything. In another case, you actually might get some back. So,
Right.
anyway.
So, Saadia, if you had any of these four women in front of you, what would you
Yeah.
ask? I mean, you're in the philanthropy world, you're interested in trying to get scale. Oftentimes,
Right.
philanthropy is about experimentation and hoping to get other folks to replicate what you're doing to
Yep.
scale it, governments, et cetera. So, four governments, UK, Canada, Australia, and the United States, what would you ask of any of those four women?
So it's easy to ask for money, and then the question is what the money would be used for, but I think there's also a leadership vacuum when it comes to the aid agencies and innovative finance. There's still it's easier to give money and just let it be when it comes to these donor organizations. It's harder to go in and try and do what we're trying to do, which is around innovative finance, where you say it's not about giving, it's putting it to use in a way where it catalyzes more money and creates sustainable solutions from a financing point of view. And I think that's a mindset shift that is underway, but there's need for leadership. Where we've seen successful solutions in the past, whether it was what's called IFIM, which is the International Finance Facility for Immunizations. It's something that was done post the MDGs to raise money for immunization programs across the world. There was leadership, there was Gordon Brown, there's somebody from the public sector that said, this is what we want to do, and we have to bring everybody around it. So that's what I would say is needed more than a redeployment of money, but both are important.
Okay, Julie?
So I think what Saadia
And these
just-
are all four shareholders of yours at the IDB.
Yes, they do. No.
Australia's
Australia's
not.
not.
Sorry.
But
The
we
other three are.
actually have a fund that we got Australia to give us some money to invest for them.
Okay.
What Saadia said is a really good point, because I think that it's leadership in that direction, and it's also sort of moral suasion on the financial markets regulatory front, because what's happened across the regulation to avoid systemic risk and future crises is to double down on regulation in a way that moves the big financial players, the commercial banks, out of any investment in any market, but God forbid in an emerging market that's greater than 10 years. Because the regulatory capital they have to hold against it is so big. And so that's happened to insurance companies and pension funds. And so it's even like outside what you'd even think about, but engaging across government and across international regulatory institutions to say that it's not just self-interested people. But on the one hand, their government is recognizing, take the Brits, that they want to deploy more and they've got constraints, and yet they're choking off the resources on the other. I would disagree with Elizabeth a little bit. I think I would say give us the $100 million and let us decide what to do with it.
And you'll send a postcard at the end of the year.
In that, you need some of it to be grant money. So I had a conversation with somebody who advises a lot of those governments, who has great influence, and they'd kind of woken up, I don't know, 18 months ago and said, yeah, so we're telling, DFID and the rest of these guys, yeah, you don't have to give grants anymore. You can get all the money back. You can do an investment. Well, yeah. Well, what about all that grant money? We need to actually develop things. I mean, if you unravel M-Pesa, you get to two DFID grants.
Yeah, it's a $5 million challenge grant.
Right. Without which, no M-Pesa, right? So I would say that, yes, we all need more money that does first loss guarantee and that kind of stuff, but we can't forget the grant money.
There's a public good component.
Yeah, without which you can't mobilize. And for lack of a few $100,000 of grant money in a deal in Colombia, we couldn't get that entity to a place where we actually had the $10 million of impact investors, but we couldn't access enough grant money to go with ours to get where we needed to go. So I think you need some of both.
So is that a role also for some of the regional, whether it's the African Development Foundation or the Inter-American Foundation, is that a role for them as well, and small grant, some of the part of the U.S. development ecosystem, is that a role for them?
One would hope that that's how they spend some of their money.
Okay, good. Okay, David?
Did I mention I was a grant-funded research
Yeah, so you're available?
Right, build the
You're available?
ecosystem. David's the ecosystem.
Exactly.
You're part of the public good?
The importance of unread white papers generated by quasi-academics is unbelievably
Absolutely.
So, I mean, just to reiterate a couple of points, I do think there's two things.
So going back to my question, if you had one of these four women who had very large checkbooks in front of you, what would you ask them?
Yeah, so I'm not trying to, I think my colleagues would divert their money better than I would.
Okay.
So I'd say give them the money.
Not to you.
I think their voice, as they give out that money, their voice on the systemic issues about how finance can better serve these communities and what are the limitations, but it's not just leverage controls. I mean, there's all sorts of things that are directing capital one way or another. And I know I'm trying to build on what you're saying.
Yeah. No, you're absolutely right.
So that's one, like have a voice in this systemic discussion about how the money is going to have an impact and the regulations and rules that govern how it's directed. And the second thing, I mean, just what we've learned in our domestic work, there is a lot of cultural understanding of how things become investable and who are the various public, private, community sector actors that make successful investments emerge that has to be grant funded.
Yeah.
It will make the work of investors much more powerful and is often left off the table when we get to the subject of finance. Okay. And I would encourage them to give some grant money to that.
All right, so this audience has been very patient. Thank you. Want to raise some hands, please? I see. I want to call on Andrew. We're going to do this World Bank style. So I'm going to call on Andrew Mack. I'm also going to call on Peter Voike, and I'm also going to this woman up front, and then my friend who runs the African Development Foundation. Those four. We're going to take those four. So we're going to start with Andrew Mack, and we're going to go to these two, and then we're going to go to Peter last. So, and everyone's going to keep these short.
Dan,
I'll keep it short, I promise.
You're taking as a group, and then we respond after.
And Wendy, we're going to cut. And so everyone's going to be short and pithy in their questions.
Okay, I'll be short and pithy and speak fast, okay? I've heard two great panels. I've heard people talk about returns, limited or diversified risk, leverage, and the need for patient capital, and a focus on solving one problem, some sort of focus when we're talking about exactly the impact we're looking for to have. And yesterday I spoke at Gallup, did a kind of TED talk talking about the future of employment, specifically looking at the issue of microfranchising. Because in my mind, we've got 25 million people coming into the workforce just in Nigeria, just in the next 10 years. If we solve all of our problems but don't solve the problem of employment, we've got a really big issue. So, to your question, have any of you worked with microfranchising as a solution? It leverages the capital of the individuals there, and if not, can we get one of those four ladies who are coming into the room with the big checkbooks?
Thank you. This woman here.
Hi, Melissa Moy from World Wildlife Fund. So I'm looking for some free advice. Should we incubate small-scale fisheries projects as a starting point, or should we tackle global challenges like climate change, freshwater, by doing big, large-scale impact investments? Or should we advocate for green bonds to actually be green? Or should we take our reserves and invest them in impact investing? So if you were us, given the fact that we have 100 offices, a global brand, and Leo DiCaprio on our board who gives us high-risk capital,
Okay.
another source of capital, I'll end.
Okay.
What would you do?
I'm available for like outside consulting. And can we talk about that afterwards? Give it to my friend over here that runs the African Development Foundation.
Great, thank you.
Everyone gets gold stars for short, so.
Yes,
Right.
Shari Barenbach from the U.S. African Development Foundation. First, just a quick check to thank David for emphasizing the importance of grant capital for helping smaller deals to become investment ready. And so that's number one. But number two, I really love, Julie, what you were pointing out about how there's really a wide range of options in terms of what people want to get in terms of risk and return. And I'm just wondering what kinds of frameworks and analysis and indices are being developed so people can start to be much smarter about how they approach this, and they're not trying to solve this problem each on their own.
Peter Broik is the former head of IFC and the former chairman of the Save the Children, the global system, and we're glad that you're a senior advisor here at CSIS.
I don't know why you always ask me.
Just because you used to run one of the largest DFIs
But it gives
in
me
the
the
world.
opportunity to home in on what I've been saying for years and years and years. And this goes back to your question, what would I ask the four ladies who have lots of money to give to do with the money? I would argue capacity building in the countries. The private sector will invest if the capacity is there, the institutions are there, et cetera, et cetera. NGOs doing a fabulous job in certain countries in capacity building. They don't have the money to do it. And I've seen projects where a NGO brought together the local government and slum dwellers. And guess what? The slum dwellers out of a sudden understood that if they pay taxes out of their little income, the government actually does something for them. Great projects where you can invest into microfinance, et cetera, et cetera. I think everybody talks about capacity building, but it's not being taken serious.
Thank you. Okay, so any of those four questions, micro-franchising, the issue of capacity building versus putting resources into actual impact investing, Shari's question, and then the woman's question about, okay, we've got some existential questions about how should we put our people, time, and money at the World Wildlife Fund. Okay, so who wants to go first?
I'll do easy ones.
Yeah, go with the easy ones. Right.
Go first, you get the easy ones.
Right.
So the Multilateral Investment Fund has in fact done micro-franchising quite a lot, a number of different projects, worked through a number of different models. There's information about it on the website, in addition to the person who's been most involved in it. And you can certainly, if you can't find that person, get in touch with me. I would also say about Nigeria, population planning would also be important in the context of those numbers you just mentioned. And the second would be, I think, Shari's point. So that's actually a really good point, which is part of this ecosystem building, which is if there were actually, we start to get to a point where we can build indices, where people can see return versus impact, trade-offs. So I can't say that there really are any, but it's, I think, something that we have to think about. And Bank of New York Mellon is likewise looking at how do they mark-to-market securities that aren't publicly traded, so portfolios can own them. And so there are all these pieces that make a market that we've got to start trying to build.
David, I'm going to give you a chance to do some easy ones.
No, there were no easy ones.
No.
I mean, I'll tell WWF what to do.
Joe, tell WWF what to
Who
do.
doesn't want to do that? I mean, it's just, so what you're going to do, right? Big NGO, you have to go into 2 years of strategic planning to determine.
And hire their group to help.
No,
Right.
we are not.
I'm available to
consultants.
facilitate the
He's
board meeting, and just kidding.
I mean, I think there's one, like other endowments, you should use all your resources in order to support these things, and impact investing is another way to think about that. And I think the environmental NGOs are coming to a different place in their relationship to impact investing. I think as impact investors, one of the values that large organizations with other kinds of credibility have is creating a halo effect for particular kinds of investments you think are good, and it's an underutilized resource. The green bonds market, for all its flaws, is, I mean, I think you should support standards in order to raise it. It's pretty impressive what's happened, and it was able to happen because the lead investor, when the World Bank came out, and said, these are green bonds, then the Swedish pension funds were able to go to their boards and say, look, we've done something for the responsible investment. The World Bank says they're green. There are all kinds of flaws with that problem, but it's still a real resource for the bank to have. It's a resource you all have, and that would be something to consider when you choose amongst your various options. I think the small scale stuff is really important and shouldn't be metrics about total social return are suspect. So having some fun to work on the small scale fisheries isn't crazy, even if the climate challenge is so great it's almost unavoidable as the central issue.
Saadia, could I ask you to just reflect also just on Peter's point about capacity building?
Yep. I think it's extremely important. And I think it's been undermined.
We have said this for 25 years.
Right.
And it's still not happening.
Still not
Yeah,
happening.
but I mean, I'll build on the example that I was using before around African risk capacity. I think the reason it's gotten to the point where it is now, it's not just about some fancy technology that allows you to see what the risk is in an insurance company. It's because that the governments are part of doing contingency planning to say, we want to be part of the solution, we have to be part of the solution, we want to have plans in place that make us do the right things. And that is everything from saying, should we be supporting lunches in schools when a drought hits so we make sure that people don't cut down on their food? That is, should we have subsidized fodder for cattle feed so that we make sure that people don't end up selling their cattle because that's what they do in situations of desperation? Or is it other things? So I think capacity building is an important part of it. It's hard to do. It's really hard to do because depending on what we're talking about, it's either at the sovereign level where you have to go and influence that and convince them of the value at the same time. And if they then don't see the benefit in a relatively modest short term, why would they continue investing in it? I think it's really hard to do at the micro level as well. So, I mean, we've been talking about it for a long time, and we'll probably keep talking about it for a long time as well. The way I view it is, as we look towards all of these solutions, we have to just keep building it in, and over time, once there's the value that comes out of it and people see what benefit it brings, it'll hopefully be easier. But it takes time and it takes a lot of money too.
Thank you. Elizabeth.
So a couple of things. I totally agree with you on the capacity building front, and I would just not forget, and we don't have the grant tools to do that, but I would not forget the benefit of large-scale investments by private sector investors with high standards of labor and job training as a vector for capacity building in many of these markets. Second thing I would just pick up on is the question about grants for investment readiness, which I didn't mean to say first loss at the exclusion of grants by any means. But we in our own experience have seen the power of a little bit of grant money for investment readiness giving rise to a huge amount of investment down the road. $20 million was allocated by the State Department for under an Africa Clean Energy Finance facility that we created. That $20 million only has seeded several $100 million of OPIC investments, which will then crowd in several hundred additional $1 million of private money. $20 million, almost $1 billion. So that's just a demonstration of that leverage effect that a little bit of grant money applied appropriately can do. And that would bring me straight to the World Wildlife Fund, of course, and I'd say I would heartily encourage you to just look at what's in your portfolio, whether it be ecosystem services projects or clean water projects or desal projects or whatever, that might actually be able to attract private capital or capital from an organization like the IDB or OPIC, which has very healthy risk appetite, 20-year financing, things that nobody else would finance. We'll finance that because one of our number one priorities is renewable resources globally, because we believe it's the biggest challenge facing the planet and mankind right now. The resource scarcity, climate change, and the growing middle class consuming those resources at an accelerating rate. So I bet that you would find in collaborations with organizations such as these at the panel here, that you'd find that there are pockets of private capital that could amplify some of your grant funds by orders of magnitudes that you may not have thought of. Otherwise, I would welcome the chance to talk to you directly and convene a group of people together to think about where private capital could play a role in achieving your goals. And that just brings me to the last point, which of course touches all these things, which I think the most important thing that we can all do is collaborate. Because everyone's got their own toolkits and their own instruments, and we're never going to get there if we keep in our own channel, applying our own, hammer to whatever nail we see. It's only by connecting and aligning our resources, our appetites, our capabilities, our branch networks you were saying earlier. The IFC has a tremendous branch network, as does IDB. We have none. Yet we have a risk appetite that exceeds theirs in many
Absolutely.
cases. So by combining those resources, appetites, instruments together, we can accomplish much, much more than we can alone. And it's all about recognizing that our processes, our cycle times, our incentives are not aligned right now. And frankly, just getting over ourselves and putting the larger goal that we all share ahead of our own institutional goals and personal goals, and just getting on with it by working together. And frankly, as Truman always says, or always said, I guess he's dead now, there's no limit to what you can accomplish if you don't care who gets the credit. And I think that's a mantra that we should embrace as the impact investing community. As the only way we're going to get there is by aligning and putting our egos aside and just getting it done.
Okay. David, you had a point you wanted to make.
Just to amplify a point that Elizabeth said, knowing what you own is the first step for an impact investment strategy, and it's surprising how few investors who enter the world haven't reviewed what they have. The stuff that you all did is really exemplary in just trying to figure out and categorize what's in your portfolio, because then you have something to build on.
Okay, we need to cut it off here. You all have been very patient. I want to thank the panel. Please join me in thanking the panel.